Hi, my name is Samuel Albang, and today I'm going to explain about some of the points in the use of facultative reinsurance.
Assalamualaikum, my name is Nur Jamri from BA24158. I'm going to present to you about the uses of facultative reinsurance.
Hi, my name is Nur Amira binti Abdullah and I am from BA24158 with Red3 ID number 2018298476.
Assalamualaikum and hi, I am Nurul Atira binti Muhammad Noor with number metric 2018259974.
Hi, my name is Muhammad Badrul Amin bin Azam from BA24158 with ID number 2018, 2006 and 24.
First point in the use of facultative insurance is to reinsure special risks, which are outside the scope of usual treaty. What does this mean? It means facultative covers specific individual risks, generally high value risks or hazardous risks that will not be accepted under a normal treaty. Policy that include coverage for special peril provide the broadcast coverage. This require protection for any cause of loss that are not excluded by the policy. Therefore, this is where the facultative reinsurance come and cover this kind of special peril. I will give an example of a situation where a fire incident happened in a hospital building. Insurer face a potential 35 million in liability. If a building is badly damaged, the insurer believes it cannot afford to pay out more than 25 million. So it tries to go to the market until it gets a reinsurer for the remaining 10 million. Another point in the use of facultative reinsurance is to seek expertise and experience of reinsurer on the risk of special nature. By accepting another reinsurer, it helps the company in obtaining a higher premium and rating. This is because the reinsurer can set an appropriate premium on a specific risk. The reinsurer also helps apply this expertise to the underwriting in protecting their interests. This also will limit on a specific risk, stabilize loss experience, and increase their capacity. This also gives help taking the risks that are not likely to occur very often.
Point is to reinsure the amount which are in the excess of existing treaty limits. So if there are some excess amount from the capacity limits, it will be transferred to the facultative reinsurers to be covered. So for instance, the claimed amount is 200,000, but insurer A only had the treaty limits of 100,000. The balance of the claims will be transferred to reinsurer A. Unfortunately, reinsurer A only had 50,000 of treaty limits. The another 50,000 will be transferred to facultative reinsurer to be covered. So the next one is to obtain the capacity of when volume of business does not justify with the treaty arrangement. So in this context, amount of business means amount of sales. Volume of business means amount of sales. And then, so this reinsurer, when a company cannot justify with a treaty arrangement, and then reinsurer will help them to obtain a capacity for the company to be covered.
Explains about to enable a company to treat its business against business of similar quality from other insurers, or we could call reciprocal exchange of business. Reciprocals is best defined as mutual exchange of insurance or reinsurance. For example, Agency A who specializes in life insurance, while Agency B specializes in liability insurance. But what if Agency A clients commit in any liability insurance cases? Is she or he will be able to claim anything from Agency A? This is why reciprocal exists. This product has the ability to share products that are different from the company products but have same benefits. More explanation please. Let's make an illustration then. So there's two agencies, which is Agency A and Agency B. Agency A is only specialized on life insurance cases, while Agency B specializes in liability insurance cases. So, one day, agency A clients get caught in liability insurance cases, but he is a client from agency A, not agency B. So what should he do? Buy another insurance? This is what agency A can do to its clients. The reciprocal process involved in this scenario will empower agency A to submit the case to agency B. Agency B can handle this case as usual and pay for any claims made. Similarly, if the agency B client is involved in any life insurance case, agency B can immediately refer to agency A to resolve it. However, when this exchange occurs, the agency that submits the case will receive a commission as a sign that they have helped another agency.
So the next use of facultative reinsurance is going to be to protect the result of treaty reinsurance by restricting insurer liability. Alright, as we know, the facultative reinsurance is tend to use only where the form of reinsurance or treaty reinsurance have been exhausted. Basically, we can say facultative reinsurance is being used to protect the result of treaty reinsurance in the situation where the risk is outside of the terms other reinsurance arrangement, or particularly we can say a high hazards. So the question is how the facultative reinsurance protect the result of treaty reinsurance. So it's basically by restricting the insurer liability. So I would like to explain more about these kinds of words, which is by restricting insurer liability. It's basically when we talk about treaty, it must be fair between two parties, between insurer and the insurer. So basically, the insurer is mostly only receive a bad risk from insurer, right? So meanwhile, all of the good risks have been retained by the insurer. So in order for the insurer to protect, to control or to ensure that they are not receive a large amount of losses of bad risk from insurer, is by restricting the insurer liability, or in other words, underwrite the treaty maximum capacities. To make it more clear, I will make some examples or illustrations. Let's say we have the retention per risk of 500,000 and the treaty maximum capacity for 1 million. So from there, we can see that the insured and insurer, the reinsurer and insurance have been agreed to share the losses, risks, and also premiums according to the proportions of 50-50. So any risk that will be received or retained by the insurer are maximum to the 500,000 only, and another 500,000 will be shared to the reinsurer. So if there's any loss of exposure or balance after that proportional, the reinsurer will transfer or submit it to the facultative. So from there we can see the use of facultative in order to protect the reinsurance, the result of insurance treaty, and in order to balance the portfolio of insurer. Okay, that is the first thing. The second thing is if the insurer have 10,000 risk portfolio that they need to retain for the maximums of 500,000. So imagine 500,000 maximum retain times with 10,000 risk, it would be 5 billion. That would be a large number, a large amount that the insurer need to retain. So in order for insurer to reduce this commitment is by the insurer can pick or choose 10 risks out of 10,000, for example, and from that 10 risks, insurer can transfer half from the maximum retentions to the facultative. So that is how the use of facultative insurance can help insurer to reduce the commitments. So that's all from me.
So far, we have considered reinsurance in terms of single risk only, but reinsurance has an important role to play in protecting an insurance account for other reasons. Need of reinsurance here provides for all these eventualities, and therefore the need for facultative can be summarized as single risk loss, catastrophe event, and higher than average frequency of loss. This might be the oldest method of reinsurance, and one of the use this facultative is to reduce exposure in areas where insurance is already heavily committed. For example, insurance company Bagus has received a proposal for 10 million wool mill For a wool mill, the company's retention is 1 million. The company has no standing treaty arrangement. This means that if company Bagus has to accept the full risk, it must go for facultative insurance and try the market until the full 10 million is absorbed. After trying 10 companies, which is say company A, B, C, D, E, F, G, H, I, and J, the final closure of the business will get an average of the million. And in this way, the whole amount has been absorbed, and there is no difficulty of the Bagus Insurance Company in assuming the whole risk of 10 million from wool mill. And you should realize from the above example that companies B, F, and I were also tried, but they refused to participate in the risk as reinsurers. Here, I state some of the other purposes of facultative reinsurance is useful to guide